Hello, my friends. Today is June 7th, and this is Markets Weekly. So this past week was a great week in markets. We had the S&P 500 surge and cross 6,000. Now, looking back on the week, it seems like there were all these little random events that popped up and then disappeared, but in the meantime had a notable impact on markets. And of course, there was also some notable data releases as well. So today, first, let's talk about the random stuff that just kind of popped up, and let's go through some bread and butter stuff like data, tariffs, and central bank decisions. All right, starting with the random events. Now, I can think of three the past week. First off, the week began with a bang as we had news of Ukraine's successful and very cleverly executed drone attack on Russia. So Ukraine was able to smuggle a whole bunch of drones deep into Russia, and these drones then kind of leapt out and were able to attack sensitive assets, military assets like Russian bombers that are nuclear capable. Now, this, of course, is a tremendous embarrassment to Russia and also suggests that the Russia-Ukraine war is escalating. Now, a day after, President Trump got on a call with President Putin, and according to this Truth Social post from President Trump, was basically confirming that, yeah, this Russia-Ukraine conflict, it's not ending anytime soon. Looks like it's getting worse. And of course, President Putin is stating strongly that he's going to have to respond to this attack. So I don't know how, no one knows the time or the place, but sometime, maybe in the near future, there's probably going to be a strong military response from Russia on Ukraine. So that's probably some risk-off event that's going to happen sometime in the future. Now, the second random event was, of course, just ongoing tariff chatter. Now, President Trump, maybe trying to show the world he's not a taco, doubled steel and aluminum tariffs to 50%. Now, if you look at a chart of where we actually import steel and aluminum from, it's largely from Mexico and Canada, basically the people that President Trump, that can't really fight back too much. So, I'm not quite sure if it had that much of an impact. Now, there were also rumors that the White House was asking other countries to submit their best trade offer to the White House by last Wednesday, seemingly to try to put an end to all this tariff stuff. My sense is that all this tariff stuff is just going nowhere, and the White House is kind of tired of it. Now, President Trump also had a call with President Xi of China to talk about trade. Now, the impetus of this was, of course, President Trump is upset that China seems to be slow-walking some of its rare earth exports to the U.S., and that's affecting U.S. manufacturing. The outcome of the call was positive, and China is reportedly loosening its export restrictions of rare earths to U.S. auto manufacturers. And President Trump also noted that he's going to go to China and meet President Xi in person. So hopefully they will iron something out. But we'll see. It looks really like Trump is continuing to be Taco Man. Okay, and the last random thing that happened the past week was, of course, the Musk-Trump spat, seemingly erupting out of nowhere. Now, as we all know, Musk was pretty close to President Trump in the early days of an administration. Indeed, Musk was a huge supporter of President Trump during the campaign. Musk controls the X platform, has a ton of money, and of course is a titan in the tech world. So I personally don't think President Trump would have won without the help of Elon. Again, the social platform, huge. Again, making it acceptable for other tech people to go and support Trump, huge. And of course, Elon gave a lot of money to the Republican Party. So this kind of dispute, I think, is somewhat surprising and also disappointing. Now, President Trump is suggesting that he would pull federal contracts from Elon's companies, and Elon, of course, is making very bold accusations against Trump. Now, this would have affected you a lot if you are an investor in Tesla, because Tesla totally tanked on Thursday, dragging down the major indexes. Now, honestly, this all looks kind of emerging market-like, where the government is mad at you and then goes after you. So this is definitely something that challenges the rule of law in the U.S. And if you are a company or an investor, it's very unsettling, because one day for whatever reason, the government can just come after you. So definitely long-term not good for the United States, and hopefully they will patch things up. Now, if you look at the history of Trump over the past decade, these things are not uncommon, right? A lot of people enter Trump's orbit, they get into disagreements, and they leave, and then new people come in, totally normal. And sometimes people leave and they even come back. So friends can become enemies, and enemies can become friends again. So hopefully, this is just going to blow over. It does seem that there is some degree of de-escalation on Friday. All right, that's all the random events that just kind of popped up out of nowhere. And I'm sure in the Trump term, we will continue to have many random events like this. Now, looking at the more concrete stuff, let's start with the big jobs market report we got on Friday. Now, the non-farms payroll report was better than expected, but only a little bit better than expected, right? So zooming out and looking at the trend of jobs created, it's a very clear trend of deceleration. And this is normal. The economy obviously is moderating. And more importantly, there's less immigration. So if you have less population growth, you're going to have less job growth. Totally normal. Now, there's really nothing wrong with this jobs report. But if you look at the details, though, it's also fine. So looking at, for example, wage growth, better than expected, pretty solid. I don't really think it's going to be inflationary, but better than expected. Unemployment rate still 4.2%, unchanged. The labor force participation rate did go a bit lower, though. So all in all, it was a totally okay jobs report. Now, what surprised me was how strongly the market reacted to this. So we have this okay jobs report, stocks surge, bond yields surge, and the dollar surges as well. Now, looking at what the market is pricing now, the market is only actually pricing in a little bit less than 2 cuts this entire year. So it could be that many investors were positioned for a very poor report and just an average report caught them offsides. I'm not sure, but it does seem like this was a pretty strong reaction. And what it tells you is that the labor market is moderating, but really, really not cracking. So the trend, though, of course, unemployment rate continues to move higher, and headline employment numbers continue to moderate. Not recession at all right now. Separately, I want to talk a little bit about this really interesting study from the New York Fed. Now, the New York Fed, of course, we're all wondering what tariffs mean to profits, to inflation, and to the economy, like economic growth. So the New York Fed did this survey of companies in the New York City area on how they are reacting to tariffs. Now, interestingly, they're showing that, looking at the survey, that a sizable number, I'd say most companies, are passing through tariffs to their consumers in some form. A chunk are actually passing all of the tariff price increases to their consumers, and a smaller chunk are not passing on any. And in the middle, you have gradations. So already, even though this tariff thing is pretty new, we already see companies responding to this. Now, this survey was conducted in the first week of May, and of course, since then, there's been a lot of changes. So these responses could have changed as well. Now, interestingly, if you look at this following survey, you'll see that one of the things that these companies are noting is that they're actually buying more American products to try to evade tariffs. So in that sense, this tariff policy really is helping American businesses that are domestic producers. Now, whether or not it's going to be enduring, I think it is going to depend on the expectations of how long these tariffs last. If these tariffs are only temporary, it's not going to result in the reindustrialization of the U.S. But if everyone expects this to go on forever, then maybe those domestic manufacturers will be willing to put down longer-term investments to be able to produce more goods and services in the U.S. So again, being able to convince the business world that these tariffs are going to be here for the indefinite future is going to be crucial to encouraging domestic businesses to continue to invest and produce in the U.S. And one other thing that's interesting about the survey is, of course, there's some impact on profits, and also, even though not all goods were tariffed, these companies are also taking the time to raise prices on items that are not affected by tariffs. Now, the survey seems to suggest that companies are maybe making a little bit less money on things that are subject to tariffs and thus trying to make up that lost profit by increasing goods that really aren't affected by tariffs at all. So, and you could think of it as an opportunistic way to raise prices, which we did see in the time of COVID as well. So that was a pretty interesting fighting. Again, this is only in the New York City area, and we have a big country, so other companies may respond differently. And of course, the tariff situation is fluid. This was done in early May. And the last thing that I want to talk about is the ECB meeting. So this past week, we had a meeting from the ECB, and Madame Lagarde lowered interest rates and seemed to suggest that they were very close to the end of the rate-cutting cycle.
As I said, I think that with today's cut and the current level of interest rates, number one, I think we are getting to the end of a monetary policy cycle that was responding to compounded shocks, including COVID, including the war in Ukraine, the illegitimate war in Ukraine, and the energy crisis.
Now that stands in contrast to the Fed, which, as I think we all anticipate, still has some ways to go. So why is the ECB ending their rate cutting, close to ending their rate cutting cycle? Well, based on the data, it seems like inflation is actually going to be falling below their target in the coming year. Now, Madame Lagarde is noting that energy prices have been pretty low, and again, energy is a big part of European Union inflation since they import it, and also the euro has strengthened a lot, so that's also both reducing import costs, but also making their export sector a little bit less competitive. So with tariffs on the horizon and a lot of business uncertainty and inflation expected to actually fall below 2% next year, the ECB is becoming a bit more cautious. So there's no need to hike rate. There's no need to keep rates high because inflation is falling below 2%. But then we're not really sure about the economic conditions. So not really sure how much to cut. So the market is pricing in just one more ECB cut this year, and then we'll see what happens. Now the euro strengthened significantly on this news because now the thinking is that with the ECB almost done and the Fed on pause and probably going to cut later on in the year, the interest rate differentials are going to close going forward. Again, this is all super preliminary, but it seems like even as the Fed is not kind of on this long pause, other central banks that moved first and more steadily are almost done with their rate cutting cycle. All right, so that's all I prepared for today. Oh, one other random news that happened, of course, was on the regulatory front, Wells Fargo was released from their asset cap that's been imposed on them since 2018. So I'll write about that and what that might imply for credit creation and the banking sector in the U.S. So that's what I prepared for today. Talk to you all next week.